Hello everyone, and thanks for joining us for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner, and I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me give you a rundown on what we have in store for today's show. First up, we're going to be talking about FANG stocks. Now, do you know what a FANG stock is? Well, if you don't, we're going to tell you in our first segment. In our second segment, we have our mortgage pro, none other than our special guest, Steve Tetzner from Homestar Mortgage. We're going to be talking about some of the myths and then the reality behind the myths when it comes to mortgage lending. So Steve's going to help us out with that. In our third segment, and closely related to our second segment, I just realized, U.S. household debt reaches a record in the second quarter. We're going to talk a little bit about mortgage volumes as well, so we have that to look forward to. And then finally, in the fourth segment, we're going to have a public service announcement on the recent Equifax data breach and what you need to do as a consumer. So we're going to be talking about all those things. So having said all of that, let's leap right into it by talking about what a FANG stock is. Now, for those of you that may be regular watchers of Jim Cramer on Mad Money, you'll be familiar with the phrase FANG stock because Mr. Cramer was the one that actually coined that term, which immediately raised a question for me. Why have I not coined a term? So I'll be working on that in the next season of the Money Pros. But in the meantime, let's talk about the one that he coined, and that is the FANG stock. So FANG is an acronym, and it stands for four different stocks that we're going to talk about in a moment, but they are all large cap stocks. And what does large cap mean? It means that the total value of all the outstanding stock is significant. In the case of these four stocks, they're among the largest stocks in the S&P 500, so we're going to talk about that. They're growth style stocks. So what does that mean? Growth means that generally whatever earnings they have, they're plowing back into the company. These are not companies interested in paying out dividend income. These are companies interested in taking whatever they make, and in some cases they actually have no income after expenses, but plowing back all of their revenue into continued growth of the company. And then finally, the third thing they all have in common is they're all tech stocks, which harkens back to the dot-com era in the early 2000s. So we'll talk a little bit about that. But let's talk about who these FANG stocks are, and we'll also talk about their performance. So I'm going to put up a slide, and let's talk about these four stocks. So the first one over on the left here is Google. Google is one of the stocks. That's actually the G. Careful viewers will note that I don't have these lined up in the order of the acronym FANG, so bear with me. But Google is the G, and this is the performance of these stocks so far in 2017 through August 31st. So Google is up 20.5% for 2017. Netflix, the N in the FANG, 41.12% just for the year. Now keep in mind, we're talking about 8 months here. So just for the 8 months of 2017, Netflix up 41.12. Amazon, the A, up 30.77. And finally, Facebook up 49.47% so far in 2017 through August 31st. So the performance is really spectacular. And many of you are probably aware that the stock market has set several records this year. And in fact, as of this taping, S&P just hit another record. And these stocks are chiefly responsible for those records being set. So let's talk about some of the other performance. You can contrast, if you recall, the performance, the lowest performance was Google, just over 20%. Contrast that with the S&P 500, of which all of these stocks are part of the S&P 500. The S&P 500 through August of this year is only up 11.93, so almost 12%. So the performance of these four stocks is really doing a substantial part in carrying the performance of the S&P 500. In fact, Facebook, Amazon, and Google, and by the way, we call it Google because it works out nicely for the acronym, but really the name of the company is Alphabet now. Those three companies are in the top 10 for market capitalization for the S&P 500. You can also look at other sectors of the stock market here in the United States. Mid-cap stocks up 5.28%, small-cap stocks up 1.13%. So as you see the market setting records, you have to keep in mind that it's really these four stocks that are primarily accountable for a lot of the performance that's being reported on the news. So that's an important acronym to keep in mind. And it does raise a question. Does this harken back to the dot-com boom and bust cycle that we saw in the late 90s into 2000? Jury's still out on that, but you know where I stand on these things. I'm an advocate for a diversified portfolio. You don't want all your eggs in one basket. In this case, I don't think you want all your eggs in the FANG basket. So that's it for FANG. Up next, we're going to be talking to Steve Tetzner about the myths and the reality of mortgage borrowing. So stay with us. There's more to come. Welcome back to the Money Pros. I'm joined now by our mortgage pro, Steve Tetzner with Homestar Mortgage. Steve, thanks for being back.
Glad to be here.
All right, it's a good one. All right, we're going to be talking about the myths and the reality. But before we do that, we always like to touch base with you on where we're at with mortgage rates. And we always want to remind our viewers that this is being taped a couple of weeks in advance, so nobody's going to hold you to these numbers, but this is the state of the markets as we record this. So what can you tell us about where we're at with rates?
Rates are actually excellent. We've seen a decrease in mortgage rates over the last week, 2 weeks. They're pretty much at the lows that we've seen since the increase just after the election. So the market's very good. There's actually some opportunities even for people who maybe bought when the rates jumped up to refinance to a lower rate right now and save a half or 3/4 of a point on their rate.
So we've talked about this before, but I think it's important to remind viewers, we've seen the Fed raise short-term rates a few times in the past 12 to 18 months. That may give people the impression that it's impacting mortgage rates, but it's really not the case.
It's actually causing mortgage rates a little bit to go down.
So a little counterintuitive.
It is.
What can you tell us about the real estate market overall in Rhode Island? Obviously, your business is directly impacted by the buying and selling of homes. So what's your sense of what's going on with respect to the state of the real estate market?
Extremely strong. Definitely a seller's market. The lack of inventory is really driving prices up continually. A lot of competition in different price ranges in different markets. That we're still seeing properties that are selling over the original list prices. So in most cases, if you see a property that's on the market for more than 30 days, it's probably priced well above what the market will bear. Other than that, just a great real estate market right now.
And I imagine a lot of that has to do with the readily available financing. People can get financed.
There's definitely been a little bit of an expansion in underwriting criteria that's helped, but very solid underwriting criteria. Nothing like we saw back in the early 2000s. Borrowers being qualified properly with proper credit, proper down payment, or if it's a no down payment, they have proper income to support. So it's, we've eliminated all those risky loan programs, but the criteria is starting to loosen up a little to allow more people to get into the market.
So all signs point to a very encouraging real estate market. It's certainly, at least if you're a seller, I suppose, right? If you're a buyer.
Yeah. Well, if you're a buyer, you just have to be a little aggressive.
Right. All right. So let's talk about the subject of today's show, which is myths and the reality that's behind them. But before we get into the forum, we have a slide and we'll walk through them. How do you think these myths get started? Like, where do you think this stuff comes from? Is it, do you have a theory on that?
I think it's a combination of people listening to relatives that bought houses 25 years ago that this is how it works, or just generalizations of people's perception without actually doing research or speaking with someone, where they're afraid to open up that initial communication with a mortgage person because they're afraid of what they might be told. Nobody likes to be told no.
And how much do you find things have changed over the years? I mean, I imagine the typical person, obviously there are refinancings and things like that, but even somebody who borrowed a lot might have 10 or 15 mortgages over their lifetime. How much does stuff change from year to year? You're doing this, dozens of mortgages a day. Like, how much does it change?
Well, I mean, in terms of the documentation is always changing because federal and state regulations are always changing. You do have to educate your client when they come in that, when you get your mortgage 5 years ago, the rules were different. There's new disclosures, there's new criteria, there's new procedures, so you just have to bear with me and we'll guide you through the process.
I think that's the theme for the show, right? You got to talk to the pros because this is a professional endeavor. So with that, let's go through some of the myths that you've observed and we'll talk about the reality. And the first one up on the slide is pre-qualify means approved. I'm pre-qualified. What do I have to worry about?
Yep, and we hear this quite often. Borrowers will come in and say, well, I've already spoken to someone at such and such bank or such and such lender, and I've already been approved for my mortgage. I'm all set. That's not what a mortgage approval is. Mortgage approval, the only person that has the authority to lend money is a mortgage underwriter. The consumer never speaks to an underwriter. They speak with a mortgage loan officer, who is a commissioned salesperson for all intents and purposes, which is exactly why they don't have lending authority, because they would approve everything. So that person is doing their due diligence to the best of their ability to examine the person's financial situation and give an educated opinion on what they're able to borrow. The problem is that, as in most industries, not everybody is good at their job, and very often you have people that issue pre-approval letters or pre-qualification letters to clients that don't qualify. And when you go out into the marketplace and you're presenting an online pre-approval versus somebody who's dealing with a local lender that has a good reputation, listing agents and good listing agents especially know the difference. So you definitely want to be working with somebody locally, look at their experience, and talk to your realtor. Ask your realtor for a couple of referrals of the mortgage people that they work with.
So pre-qualified doesn't mean approved, but there are definitely better pre-qualifications than others, I think is the point that you're making, right?
Yeah, absolutely. I mean, there are online engines where people can go online and they plug in their information, say, oh, generates a letter saying they've been pre-qualified for a mortgage. Well, until that information is validated, it means absolutely nothing. So you definitely have to speak with the people. But even when you speak with the loan officer, it does not mean your mortgage is approved. You still do not have a mortgage approval till you actually apply, fill out the information, supply your documentation, and a mortgage loan underwriter issues a commitment letter. That's when your mortgage is approved.
So as a borrower, it's not a done deal until you actually get that mortgage commitment from the underwriter.
That's correct.
And as a seller, keep in mind what you're looking at when somebody tells you you're pre-approved, because that information can vary pretty widely, it sounds like.
Correct.
All right, next one on the slide. Let's talk about this. You need perfect credit. Now, you need good credit. How good does it have to be?
Well, with certain government loans now, we're actually seeing loans that are being approved with as low as a 580 credit score.
Okay.
There are no money down programs that we're seeing that are getting approved with as low as a 600, 610 credit score. So depending on what the other criteria is that other than just the credit score, we're really analyzing, what caused that score to be low, or what, in some cases, people have these high credit scores, and you look at their credit profile, and it's maybe not indicative of what their credit rating should be, maybe.
Okay.
In terms of, do they pay their bills on time? How many trade lines do they have? How much revolving debt do they maintain? Are they keeping their credit card balances low where they're not overutilizing their revolving credit? So there's a lot of different criteria, but that's a myth. You don't need to have an 800 credit score to buy a house.
Now, since we're on the topic, can you give us an idea of what credit score would be, at which point, there or above, you're going to get the most competitive rates, and then where things start to get adjusted down from there, potentially? Because I imagine the less your credit score, the more expensive the loan's going to be.
Well, the higher the credit score, the better the interest rate and the better the terms of the loan.
Sure.
And yes, the reverse is true. So to get the absolute best terms across the board, 760.
Okay.
And then it drops to 740, which is still going to put you in that top bucket for all intents and purposes. Once you start getting below that, then the interest rate, and if you don't put 20% down and have to maintain some type of mortgage insurance, that's also affected by your credit score. So when you get under a certain level, then you probably phase yourself out of a conventional Fannie Mae type of loan and more into a government-insured loan.
But the message here for people is if you're sitting home and you're hesitant to talk to a mortgage lender because you don't think your credit score is up to snuff, you really have to go talk to the lender, because you might be wrong and you might be pleasantly surprised.
Yeah, and you may also find out that, by making a few minor adjustments in 3 to 6 months, I've corrected my problem.
Could get even better.
And I can buy.
That's an excellent point. All right, number 3 on our list, you need a 20% down payment. Now, this is sort of one of those this has been around forever, this idea. Where does this come from, and why is it a myth and not the reality?
Well, I think it goes back to the days when our parents bought houses, and that's what bank. You walked into your local bank and you sat down with the assistant branch manager, and you bought a house for $35,000 and you had to put $7,000 down. Those days are gone. In Rhode Island, there are excellent competitive first-time homebuyer programs with no money down. There are government programs like USDA and VA that allow no money down. Government programs with 3.5% down, and a regular conventional loan you can do with as little as 5% down. So there are, depending on your income, your credit rating, in your cash situation, you could be looking at a no down to as little as a 3 to 5% down payment.
So I don't think we would discourage anybody from saving up some money before they buy a house, but this means that They could potentially use that money for repairs. They don't have to throw it at the down payment. It gives you a lot of flexibility.
They don't, and you also have people that are paying high rents right now, and I've seen the market where the prices are getting up. It's a little less competitive now with being able to put someone in a less expensive home, where I put people into homes with no money down, where their mortgage payment with taxes and insurance are less than their rent.
So that's an important myth to keep in mind. And then sort of the, maybe not corollary to that, but related myth, which is the last one we have, you need 20% down to avoid the PMI. That's not true either?
That's not true.
Okay.
So,
and let's talk about what PMI is first, because we like to throw around the jargon
absolutely.
sometimes.
Yep. PMI stands for private mortgage insurance. So that is insurance on the loan. In the event that you default, this insurance company will share the loss with the lender. So without this insurance or something similar to it, in the past you haven't been able to get a mortgage. The way that you can avoid it is with a blended mortgage, where you have the old 80-10-10, where you borrow 80% first mortgage, a 10% second, you put a 10% down payment, you have two loans, no private mortgage insurance. There are also programs with people with high credit profiles where they can take a very slightly higher interest rate on the loan. So instead of paying monthly private mortgage insurance, they can build it into the interest rate of the loan, which makes that interest tax deductible, gives them a better tax benefit, and a lower payment over time.
So there are 4 myths and then the reality behind them, but I think it points out the overall, like I said earlier, sort of the objective of this show, which is you really got to talk to the professionals. This is not a DIY business, and you might be pleasantly surprised at some of the news. What you think you knew isn't actually the case.
That's very true.
Steve, great information as always. Appreciate it. Thank you very much.
Glad to be here.
All right, when we come back, we're going to be talking about record levels of consumer debt, where the numbers are at right now. Stay tuned. There's more to come here on the Money Pros. Welcome back to the Money Pros. All right, on the heels of our advice from our mortgage pro, Steve Tetzner, we're going to continue our conversation about consumer debt. Some interesting data recently came out on where we're at as of the second quarter of 2017. So I wanted to share it with the Money Pros audience. So basically, in the second quarter, total household debt, which is comprised of a variety of things, but we're not talking about corporate debt here. We're talking about individual consumer debt. Total household debt reached $12.8 trillion in the second quarter of 2017. So a couple of notes about that. One is the 12th consecutive quarterly increase in the level of consumer debt, and it also sets a new record as the highest level of total consumer debt ever. It's important to note, however, that those figures are not adjusted for 2 important things. One is the size of the economy, and 2 is the size of the population. Those 2 things would automatically inflate the level of consumer debt, even if consumers individually were not necessarily taking on more debt. So keep that in mind as we talk about some of these numbers. But the total consumer debt, that $12.8 trillion figure, is driven by 3 primary categories. So I want to talk about each one of them. First up, as we put up a slide here, is credit card debt. Credit card debt is up $20 billion in the second quarter. So credit card debt is obviously revolving debt on your Visa, your MasterCard, your American Express. An important thing to note here, 6.2% of balances are 30 days delinquent, which is up from about 5.1% a year ago. So the level of 30-day delinquencies is ticking up. Level of 90-day delinquencies is ticking up as well. But it's well below the level that it was during the financial crisis. 30-day delinquencies were actually over 13% in 2008. So we're nowhere near those numbers. The next driver of consumer debt, and this is in order of increasing levels of debt, auto loans. Car market is hot, and it's being driven by available credit for car loans. Auto loans up $23 billion in the second quarter. So some notes on auto loans. $148 billion of new loans were issued in the second quarter, so that's an increase of $23 billion from the first quarter. $51 billion of that $148 billion, so a little over a third of those loans were lent to what the auto industry considers subprime borrowers, those people with credit scores under 660, and that is the highest level in the past 10 years. So auto loans are a booming business. And finally, the expertise of our mortgage pro, Steve Tetzner, mortgage loans up $64 billion in the second quarter, no doubt driven by a very strong real estate market. So that's the biggest category of household borrowing is mortgage loans. Borrowing is at 0.8% below its 2008 peak. So as high as mortgage borrowing is right now, it's not up to where it was in 2008. And it's also important to note that delinquency rates are down. So while it may seem a little scary that consumer borrowing is up, and it's something you definitely have to pay attention to, it's also a sign of high consumer confidence and a strong economy. So take these numbers with a grain of salt, but it's important to know what's going on. And be sure to watch your own debt. Just because other people are borrowing doesn't mean you have to. All right, up next is going to be a PSA on the Equifax debacle with stolen data, so stay with us. Welcome back to the Money Pros. So as of this taping, the news about the data breach at credit database Equifax that news is about 4 or 5 days old at this point. But I thought it was worth talking about on the show. The first thing I want to just take an opportunity to say is Equifax should really be ashamed of themselves. Not only is a company who's entrusted with all of this data, I mean, their business is to collect financial information on U.S. consumers. That this should even happen is atrocious. But the way they've handled this is even more scandalous in my imagination. There are rumors that executives sold stock in Equifax prior to this information about the breach being released to the public. All the indications are that Equifax knew about the breach for as much as 2 months before telling consumers about it. And now they've released information on what you need to do as a consumer, and there's a lot of rumors about whether this is actually helping consumers or self-dealing. But let me throw up a slide really quickly and say that you can go to the Equifax website, and this is worth doing. Go to the Equifax Security2017.com website and at least put in the last 6 digits of your Social Security number and your last name to see if they think you may be a victim of the breach. Then I would recommend getting a free copy of your credit report at annualcreditreport.org and even considering putting a freeze on your credit. But think twice about using Equifax's free credit monitoring service, because who knows how long it's going to be free and if it's just a scam to get you to buy it after year's up. All right, that's it for today's issue of the Money Pros. We hope you join us again next Sunday right here on the Money Pros. Thanks for watching, folks.